Hello, everybody. Adam Bergman here, tax attorney and founder of IRA Financial. On today's video, everything you need to know about the self-directed IRA, IRS prohibited transaction rules. And this is a masterclass because I've written 8 books on self-directed retirement accounts, so I kind of know my way around the IRS prohibited transaction rules. So on today's video, I'm going to teach you everything you are going to need to know to understand what you can and cannot do with your self-directed IRA. So I plan on going through 4975C, which is the core of the IRS prohibited transaction rules. I'm going to talk also about 408, which talks about life insurance and collectibles, 2 category types that are not allowed to be made with an IRA. And then ultimately, we're going to do some examples. We're going to talk about penalties. We're going to have some fun. It's going to be a lot of fun. I actually love talking about the IRS prohibited transaction rules. Why? It's like a puzzle. Everything obviously is based off facts and circumstances. So one particular prohibited transaction scenario is going to be different than the next. And that's what I spend most of my time on, is talking with clients about what they can and cannot do in their IRA. And it's really like solving a puzzle. And that's actually why I became a tax lawyer, is because I like the tax code and I love the fact that you can navigate the code. And sometimes you do have to go through regulations or revenue procedures or revenue rulings and even case law to come up with an answer. But the code is like the Bible, and that's the first primary source. And that's the central figure in determining what can and cannot be done from a tax standpoint. So it's like solving a puzzle, whether you call it a Lego or just board puzzle. It's a lot of fun. So the IRS doesn't say what you can invest in with an IRA, thankfully, right? Because when they created IRAs in 1974, they certainly did not conceive of the concept of cryptos, right? There's NFTs, cryptos, even private equity, hedge fund, those types of investment structures were not really prevalent or even understood back in 1974. So the drafters of this provision were very smart, and they basically said, we're going to say what you cannot do, not what you can do. So this way they do not have to keep adding investment categories to the rules. Okay, and there's basically only 3 things you cannot do in an IRA. That's it. So the prohibited transaction rules are not super complicated. If you look at other areas of the tax code, like foreign taxation, even subchapter S, partnership tax accounting, you look at control group rules, look at what would I say? That's also transfer pricing, subpart F. Those are complicated areas, right? You talk about dividends from controlled foreign corporations, PFICs, CFCs. That's complex. This is easy. There's only 3 things you can't do. Can't buy life insurance, okay? Meaning you can't have a policy that is going to name your IRA. You could in a 401k. There are some limitations on how much of the contributions can be used to pay the premiums, but you can do it. The second is collectibles, and that's under 408 of the tax code. 408M as in Michael. And collectibles are generally, at least in the tax code, are tangible, like art or baseball cards or stamps or antiques. There obviously did not conceive of the concept of intangible type of collectibles like NFTs, non-fungible tokens, but there assumingly will be some greater clarity on that from the IRS's standpoint. But those are the 2 categories under 408 that are not allowed to be invested with an IRA. And then the third and the broadest category, which I'm going to spend the largest amount of time on in this video, is 4975, Internal Revenue Code section 4975, C as in Charlie. And I'm going to summarize what C says, and I'm going to break it down literally into each subsection. And 4975C says in sum the following. When your IRA makes an investment, it must be done exclusively 100% to benefit the IRA, and yourself, the IRA owner, nor any disqualified person can in any way directly or indirectly personally benefit from that transaction. Okay, that is in a summary format what 4975C says, okay? And the idea is like this. If you are going to make an IRA investment, the IRS is saying this. It needs to be done to benefit your IRA, right? The whole point of why IRAs were created is so people could accumulate wealth to help themselves out and their family out in the future during their retirement. Retirement age, you can call it now age 73, which is the required minimum distribution age for pre-tax IRAs. So the IRS doesn't want you taking your IRA out today to buy yourself a Tesla or a Rolex or buy yourself an apartment on the beach. You can do that down the road, but they don't want you helping yourself out now because that will defeat the whole purpose of an actual retirement account. So these rules are intended and protected with that in mind. Okay, so just remember that. That is the most important item to keep in mind when considering what the intention of the IRS prohibited transaction rules. And you should keep that in mind because when you're analyzing a fact pattern, we'll go through a bunch of them here, keep that in your head. Say, okay, if I'm the IRS and I created these rules back in 1974, is this the transaction you think they're looking at? Would this be fair to them? Or is this something that just doesn't seem fair? Okay, so this is kind of a breakdown in a little bit more detail, but don't worry, I'm going to actually break down each provision of the alternative investment type of strategies and how the prohibited transaction rules work. Okay, so basically, as I mentioned, you can't benefit in any way, indirectly or indirectly, right? You cannot buy, sell, or exchange property between an IRA and a disqualified person. You can't invest in a business that is controlled by a disqualified person. You can't provide any active personal service to a disqualified entity, an entity controlled 50% or more. And I'm going to go through all the disqualified person rules, but I just wanted to kind of lay it out here before we dive into each particular provision. Okay, I mentioned this, the IRS doesn't say, and the code doesn't say what you can do, only what you cannot do, which is a good thing. So this is the key, okay? In order to have a prohibited transaction, you need two things. You need an IRA, okay, we got that, and you need a disqualified person. If you don't have both, there's no prohibited transaction other than collectibles or life insurance. For 4975C purposes, you need the following two things. That's it. You need an IRA or a 401k, you need a plan, a retirement plan, and you need a disqualified person. That's it. Okay, so the key is now we know what an IRA and a retirement plan is. That's not that difficult. The more difficult question is, what is a disqualified person? And 4975E, as in Edward, talks about what a disqualified person is. I just simplified it for you for these purposes. But the core of who a disqualified person is the following. Can't be you as the IRA owner. It can't be your lineal descendants, your parents, your children, your spouse, daughter-in-law, son-in-law. Okay? It can't be a fiduciary, right? Someone who's providing services, giving you financial advice. So if you have a financial advisor that's your advisor, that's okay, but you can't then buy a house from him using your IRA. Okay? Someone who provides services, like IRA Financial technically is a disqualified person. We provide services to your IRA. So if we wanted to do some other transaction involving your IRA, not relating to the administration, that could potentially be prohibited. The employer is not relevant to an IRA. The employer organization, that's not relevant. Someone who owns 50% or more of an entity. Okay, so if an entity is owned 50% or more by a person, by the IRA owner or a lineal descendant of the IRA owner, then that entity is a disqualified person. So if my IRA, if I own 50% of company A, so it's 50% or more, that company A is disqualified. If I own 80% of company B is disqualified. If my wife owns 51% of company C is disqualified. If my dad owns 80% of company X is disqualified. Okay? If my brother or sister owns 80% of company Y, not disqualified. Why? And we'll see in a second. Siblings are not disqualified people. It's lineal descendant. It's up and down the family tree. Parents, children, spouse, daughter-in-law, son-in-law. Okay? And then any entities that are controlled by such persons, those entities become disqualified. right? So if it's me, my parents, my children, my spouse, my daughter-in-law, son-in-law, my grandparents, they own 50% or more of any entity. It could be a partnership, it could be a corporation, it could be a trust. For a trust, you look at the beneficiary. Who are the beneficiaries? If 50% or more of the beneficiaries are a lineal descendant of mine, that trust is disqualified. And what does a disqualified person mean? My IRA cannot transact with them. Just because you're disqualified, that doesn't necessarily trigger the prohibited transaction rules. What triggers the prohibited transaction rules is if the disqualified person engages in a transaction with the IRA. That's what creates the volcano effect and creates this problem. So just having a disqualified entity out there is fine so long as my IRA doesn't do anything with it, right? If I own 58% of a company X, but my IRA doesn't do anything with it, who cares, right? My friend could transact with that entity, no problem. But my IRA or my lineal descendants cannot transact, or their IRAs cannot transact with that entity. So this is one that people get confused about. So it says here, a 10% or more owner, officer, director, or highly compensated employee of C, D, E, or G, which basically means some people just look at this and say, hey, if you own 10% or more of a company, that entity is disqualified. No, that's not what it's saying. It's saying if you have an entity that is 50% or more owned by a disqualified person, then that entity is disqualified. And then any person that owns 10% or more of that entity, or any officer, director, or highly compensated employee, someone who makes more than $155,000 from that company, that entity that's owned 50% or more by a disqualified person, then those folks are also disqualified people. Why is this rule important? Is because let's say I owned 65% of company Y and John Doe owned 12%. The IRS is basically saying, listen, we don't want you giving the money to John Doe because maybe John Doe is going to somehow help you out indirectly by putting the money back in the company or somehow doing something that's not proper. So that's why they basically want to carve out to say any entity that's 50% or more owned by a disqualified person, that entity is disqualified. But on top of that, any 10% or more owner of that entity, any officer of that entity, any director of that entity, any highly compensated employee of that entity is also a disqualified person. But don't take this separate from that. It's not, any director of any company, my dad's a director of company A, so I can't do a deal with company A. No, that's wrong. As long as your dad doesn't own 50% or more, any family member, lineal descendant, owns 50% or more, just because your dad's a director of company A, you can still do a deal with company A because technically company A is not a disqualified person, right? This only gets triggered based off this, okay? So that's something to keep in mind. A lot of people don't understand that. Doesn't come up that much. That's why it's generally just a 50% rule. But we'll go into some facts down the road, some case law. There's one case in particular, Rollins v. Commissioner, that I like talking about because it really gives a good snapshot of things to consider when you also are looking at the prohibited transaction rules and you've come to the point where you're like, I think I can do this. There's always one last question to ask. So who is not disqualified, right? Brothers, sisters, aunts, uncles, cousins, friends, neighbors, anything that's not lineal is good to go. Okay. And brothers and sisters, siblings are not disqualified people. Either are stepchildren, right? As long as you haven't adopted your stepchild, a step-parent, stepdad, stepmom, they are not disqualified persons because you don't have that lineal descendant relationship. Okay, I'm going to break down now 4975C1, A, B, C, D, E, and F. These are the provisions in 4975C. These are the A, B, C, D, E, F. So these provisions that I'm going to mention, okay, these are all the provisions these 6 provisions that make up 4975C. So I'm actually going to break it down for you. So this is actually what the tax code says, okay? 4975C1A. And again, if you do not trigger one of these, you don't have a prohibited transaction, right? You need an IRA or retirement plan. You need a disqualified person, and you need to violate one of these, C1A, B, C, D, E, and F. Here's A. And this is the first 4 are pretty obvious. The direct or indirect sale, exchange, or leasing of property between an IRA and a disqualified person. You see, I have disqualified person in blue, right? Without the disqualified person, you do not have a prohibited transaction. Nothing to worry about. Okay? Direct or indirect sale, exchange, or leasing of property to an IRA and disqualified person. I can't sell my house to my dad. I can't sell an asset to my son. Okay, here's an example. Jack sells an interest in a piece of property owned by his IRA to his son. Very basic example. Clearly obvious. It makes sense. If you were able to do this, then everyone would just do this, and you would get around the requirement of distribution rules. You would get around the distribution rules. Why are prohibited transaction rules important? As I mentioned, the IRS wants to make sure we're saving for our future. That's the intent of the IRA rules. And number two, they have to protect the distribution rules. And this is especially true for a pre-tax IRA. Roth, not as much, because a Roth is after tax. But for a pre-tax IRA, if you pull the money out before 59.5, you pay tax and a 10% penalty. If you pull the money out after 59.5, you pay tax, ordinary income tax. So if I was just able to get my assets out of my IRA and give it to my kids, then I'd have nothing left in my IRA, so I'd pay no tax, and my kids get the benefit. And the IRS correctly assumes that if your kids benefit, you benefit because it's family. Close enough. So that's A. A is obvious. B, the direct or indirect lending of money or extension of credit between an IRA and a disqualified person. So I lend, here, Keith lends his wife $10K from his IRA. Obvious, right? Same idea as A. Doesn't make sense. Obviously, in this case, the IRA, even if the IRA is getting 10% rate of return, you're doing it to help your spouse. You're not doing it to help yourself or you help your IRA. So you're helping yourself. You're not helping your IRA. This provision is why you have to do a non-recourse loan. A lot of people ask me, Adam, why do I need to do a non-recourse loan for real estate? So the tax code says it. And why? This is why. Because you are not allowed to extend credit to your IRA. And when you personally guarantee an IRA loan, what are you doing? You are extending the IRA credit. I didn't make up the rules. This is from the tax code, right? It's the beauty of the tax code. It's all concrete. It's all black and white. It's all written in the code. That's why some clients tell me, well, Adam, I saw this on the website of this other place, this other company, a competitor, or some other source. I say, okay, what's the source from that source? Are they citing to the code? Is the guy citing his opinion or her opinion? Is it from the IRS website? Is it from a case, revenue rule and revenue procedure? Where are you getting this info? Oh, I don't know. It's from this page. Anyone could put a page online, right? My 12-year-old kid could. Doesn't mean it's right. So I always ask for a source. Where is this information from? This is right from the tax code. Okay. So A and B are easy. C, the direct or indirect furnishing of goods, services, or facilities between an IRA and a disqualified person, right? Here's an example. Eric buys a piece of property with his IRA and hires his father to work on the property, right? So what do we have here? We have an IRA and we have a disqualified person, the dad, and we have now a violation where the dad is doing work on the asset owned by the IRA. So you have a disqualified person that's furnishing services or goods to the IRA, and he's a disqualified person, and therefore it is prohibited. And again, a lot of people kind of get bent out of shape on this one, and they say, Adam, why can't I provide services to my IRA? That's stupid. I should be able to help my IRA out. I agree, but I didn't make these rules up, and this is why you can't. It's in the tax code. Now, there are Treasury regulations under 4975-6 that says a disqualified person can provide reasonable necessary services. So obviously, you can find an IRA custodian, right? You can find an accounting firm. You can find a law firm. You can pick the property. You can sell the property. You can pick the tenant. You can decide I'm going to charge X per rent or Y per rent, or I'm going to paint the house pink or blue. You do have the ability to make decisions. But actually furnishing, like physically furnishing goods and services is a no-no. Now, could you sit on your computer and do research whether you should buy NVIDIA or Apple with your IRA? Yeah, it's reasonable and necessary to figure out how you're going to invest those funds. The IRS understands that. They know that's reasonable and necessary. It's your IRA. No one's going to figure that out for you. It's your money. But is it necessary that you paint the fence, build the bathroom, mow the lawn? No, that's not reasonable and necessary. You should get a third-party, non-disqualified person to furnish any goods or services. Okay, now we're getting into D, E, and F, which I call kind of the catch-alls. Okay, A, B, and C are pretty direct and obvious. D, E, and F are more like wild card catch-alls that the IRS uses in a lot of case law. So let's go through D. 4975 C1D says the direct or indirect transfer to a disqualified person of income or assets of the plan. Okay, so some people say, well, this is pretty obvious, Adam, but here's an example. Dan is in a financial jam and takes $12,000 from his IRA to pay his mortgage and credit card bill. So here you have a transfer directly from an IRA to a disqualified person. Okay, so this is pretty simple too. It's pretty obvious, right? This is more of a catch-all because it's broader. It's not talking about services. It's not talking about lending money. It's not talking about sale or exchange of property. It's just overall saying transfer of income or assets, which is a much broader term than more specific services or property or credit. So that's why I say it's more of a catch-all for A, B, and C. This kind of covers everything. So whatever you're transferring to a disqualified person, if it's not benefiting the IRA exclusively, it's going to be an issue under the Prohibited Transaction Laws. E is in Edward, another catch-all. The direct or indirect act by a disqualified person who is a fiduciary, and that's key. This is for someone who's a fiduciary. Not everyone's a fiduciary, whereby he or she deals with the income or assets of the plan for their own interest, their own account. So someone who's a fiduciary, someone who either gives investment advice or has management control over that IRA. So your financial advisor could be a fiduciary. Okay, it's someone who's taking management, investment decision, discretion over your account is a fiduciary. So this really focuses more on, could be a real estate agent, could be a financial advisor that somehow is doing deals where the deals are not only just benefiting the IRA, but it's also benefiting them. Okay, so here's an example. Jessica is a real estate agent, uses her IRA funds to buy a home and earns a commission, right? Or your son, your dad, your mom, or any fiduciary who could be a disqualified person does something to benefit themselves and not their IRA. That may be ethically an issue. It could be criminal as well, or civil, but it also could be a prohibited transaction. So this, again, focuses more on fiduciaries. F also focuses on fiduciary, but also very broad. Receipt of any consideration by a disqualified person who is a fiduciary, right? So your dad may not be a fiduciary. If your dad's just your dad, he's probably not a fiduciary. Your financial advisor, someone provides services to your plan, is a fiduciary, could be a fiduciary, and also could be a disqualified person. So E and F talks about those folks who does something for their own account with the IRA, which is benefiting them instead of the IRA. Okay, and again, this could violate other statutes, whether it's criminal or civil or ethical or regulatory, but it also could trigger prohibited transactions, which could obviously harm the IRA owner and the fiduciary. So these are broader. The last two focus more on fiduciaries, whereas A, B, C, and D focus on any disqualified person. So these are the disqualified person rules: A, B, C, D, E, and F. If you do not violate A, B, C, D, and F, probably didn't do a prohibited transaction. Okay. Now 4975D, I talked about life insurance and collectibles. 4975D as in David has the exemptions to the prohibited transaction rules. So if you are in D, you're not in C. That's good. D will trump C. So what's popular exemptions? And unfortunately, there's not a high volume of exemptions that you and I can use in our everyday investment life. The most popular ones are the loan, a 401k loan. The reason you can do it not only is in Section 72, but it's also exempted under 4975D1. So the reason you can borrow up to $50,000 or 50% of your account value, whatever's left from your 401k, is because D says you can do it. And that's why it's not prohibited. Some people say, Adam, how can you do a loan in your 401k and not your IRA? Doesn't make sense. Should be prohibited. No, D says it's allowed. And if you're in D, you're out of C. And then the ROBS, the Rollover Business Startup Solution, takes advantage of D13, which says that a 401k could buy what's called qualified employer securities, which is the corporate stock of the adopting employer. So if you work for Tesla, okay, your 401k could buy stock in Tesla, and that's allowed. That's not going to be a prohibited transaction. So what ROBS has become is, entrepreneurs, small business owners have used the principles of 4975 D13 to take the same principles and then use it to small businesses like restaurants or consulting companies or manufacturing companies, and allow the 401k to buy the stock in the company, the adopting employer, without triggering 4975C. And once you're in D, you're out of C. The other ones aren't really relevant. The only ones that sometimes come in handy is like if you have a family member, a lineal descendant that's also like a stockbroker, there's some exemptions on commissions and stuff they could earn. But otherwise, most of the other stuff isn't super relevant. So now let's go into some fun scenarios. And I'm going to kind of go through some of the most popular scenarios, and then we'll talk about whether you can do it or not. And unfortunately, I can't give you a blanket answer because there's no blanket answers. Why? Because it's all facts and circumstances, right? The answer I provide to person A may not be the same as I provide to person B, because person A and person B have different facts and circumstances, okay? So let's do a couple here. Facts. Want to buy real estate and need to use some personal funds in the conjunction with IRA funds to buy the property. What does the Internal Revenue case say? So here, I got 100 grand personally and 100 grand in my IRA. Can I do it? Can I aggregate the funds? Now I have 200K and buy the property. Okay, so let's look at C1D. C1D says you can't transfer property from an IRA that benefits a disqualified person. So now we have to say, does this transaction benefit a disqualified person? You're going to say, no, this is a great deal for my IRA. The fact that I'm using personal retirement money is not in any way going to benefit me. Maybe I could have made this investment with personal funds. Hey, I have 200 grand in my personal bank account. I could have done this. This investment is here to help my IRA. Now, obviously, if you're Warren Buffett, no problem. You got more than 200 grand in your personal bank account. If you have 25 cents in your personal bank account, maybe that analogy is more difficult to cross, and maybe it's more difficult paradigm to walk through to argue that it did not help you personally. What does E say? Act by disqualified person who's a fiduciary, where he deals with the income or assets for their own interest. So you would be your own fiduciary, and now are you acting in your own interest? And that's why, again, I keep saying it's facts and circumstances. It is. It's why there's not a lot of prohibited transaction cases, because the IRS doesn't like litigating facts and circumstances cases. They like litigating cases that are based off black and white letter law and the tax code. And here, the case falls on facts and circumstances. Did you have a personal benefit? So now let me bring in a very interesting case I mentioned, Rollins v. Commissioner. It's a 2004 tax court case. This guy Rollins, and I've referenced this case many, many times in the past. This guy Rollins was an accountant, and he owned a bunch of businesses, all under 50%. He was not an employee of any of the businesses. And this is an important fact. The companies needed money. So what he did, he took his 401k and he lent those companies money from his 401k. Regular interest rates, no below interest rate deal, fair market interest rates. And the companies paid the loans back. So it was a very win-win investment for everyone. The IRS somehow caught wind of this. They audited Rollins, and they argued he did a prohibited transaction. They said that the loan personally benefited him, and he only did the loan to help him out. Because their argument is, but for the loan, you may have lost your personal investment because the companies didn't have enough money to have a going concern and continue to operate. And he said, no, I'm under 50%. Look at the tax code, disqualified person. I'm under 50%. Tough luck, you lose, IRS. And it was a good deal. The companies paid prevailing interest rates. My 401k made money. It's It's a win-win. Why are you bothering me? And that should have been the end of it, right? But no, the tax court ruled for the IRS. And they basically said that Rollins could not prove that he did not personally benefit from that loan. So that's why I said facts and circumstances matter. If Rollins was able to show the company was able to borrow the money from other sources, there was a couple other lenders that was willing to lend those companies funds, he wins. I think he wins, right? So facts and circumstances matter. That's why I'll just kind of selfish plug here. Our annual consulting service is so valuable. I'd say 85% of our clients, are part of it. It's a great membership program. It's like $299 a year for the IRA, and you get access to, me if you want it, but our whole team. And this is the kind of stuff we'll talk to you through. Sometimes we don't have an answer, but at least we can give you clarity and give you all the rules, and then you could decide whether it makes sense. Yes, you should do it. No, you shouldn't. Maybe there's other good facts and circumstances you want to focus on, or maybe you want to restructure the investment to take advantage of some better facts and circumstances that will help you, get around any potential prohibited transaction issues. So the Rollins case I always find interesting because here you have a situation where he's clearly owned less than 50%. So on its face, if you look at 4975C, he should be in the clear. But then I mentioned, D, E, and F, which are more the catch-alls, and the Rollins case did that. They focused on D, that basically said, hey, you have a transfer, right? Basically, here's D. A transfer to or use by or for the benefit of a disqualified person of the income or assets of the plan. Rollins made a good point. He said, IRS, there's no disqualified person here. You're wrong. The company's not a disqualified person. No one owns more than 50%. And he was right. I agree with that. It clearly should not. I think it was the incorrect ruling. But the IRS and tax court, the tax court incorrectly ruled. The tax court basically ignored the requirement of a disqualified person. And they basically said, and they then used E and F and said, hey, you're a fiduciary. It's your IRA. And you basically use the income or assets of your plan for your own interest. Okay. So that's how they got around D, is they said, okay, fine. Maybe D doesn't work. And they referenced D and E and said, fine. Now we'll just throw E in there and say, hey, you're a disqualified person, right? It's your IRA. You're also a fiduciary. Every IRA owner is a fiduciary because you're making investment decisions for your IRA. You can't give away your fiduciary responsibility. There's actually a tax court case where someone tried to do it. In one court case, they were successful, and then this other case overruled it. And then there's been IRS or I would say rulings on that as well. But you cannot basically relieve yourself of your fiduciary duty, right? Because you're making investment decisions. So E says Rollins is a disqualified person who's also a fiduciary, and he's dealing with the income or assets of the plan for his own account. He's done. So you can see how broadly these prohibited transaction categories could be utilized to potentially turn a good investment on its face into something that's prohibited. So as I mentioned, it's facts and circumstances. It's also risk and reward, right? When it comes to a prohibited transaction, and I'm going to talk about this when we talk about penalties, generally the less money at stake, the less the risk is, right? If you put $5,000 in, generally the most you're going to lose is a percentage of that $5,000, whether it's tax, if it's a pre-tax IRA, or maybe a 15% penalty, maybe even up to 100% if you don't correct it timely. But it's of the amount involved. And generally when you do a prohibited transaction, it's deemed prohibited the day you make the investment. Okay, so if you put in $5K, even if it goes up, the prohibited transaction occurs on the beginning of that year when that transaction occurred. So you have to look at reward versus risk. If you put $1 million in, you don't want to do a prohibited transaction because you're going to pay tax, potentially excise tax of 15%. It could go higher on that amount, including any disqualified person. So you got to be super careful. The less involved, obviously, the less risk. And the other thing is there's only a 3-year statute of limitation. President Biden in the Build Back Better bill of 2021 tried to increase the 3-year statute of limitation for prohibited transactions to 6 years. It did not go through. In the 2025 proposed budget by President Biden, also tried to expand the statute of limitation from 3 to 6. Well, he's got to get elected in order to have a chance to get that passed. And I actually did an emergency video on that on Tuesday. So you can check out our YouTube channel if you just want to watch it. And I go through some of the other IRA related provisions that are in his proposed budget. He also, on an IRA front, there's language in there that would deem beneficiaries of IRAs also disqualified people. So the fact that they're including that, I think there's a good argument to say that if your niece or nephew or friend is a beneficiary now, that they are not disqualified people, because if it was clear in law, then they wouldn't have to amend and add that provision to 4975C. Another thing is your IRA or your retirement account, technically under 4975E, is also not disqualified. So transactions between IRAs or Roth IRAs or traditionals, technically under 4975E, you don't have a disqualified person because the IRA is not disqualified and there's no personal benefit. Now, could the IRS argue 4975C1E, fiduciary, using plan assets for their own benefit? Maybe, but it's going to be more difficult because it's not a disqualified person and there's no personal benefit because it's transactions between IRAs. I mentioned penalties, right? That's always important to think about because, if you do something bad, you need to know the cost. If the cost is you get a 1 cent penalty versus $1 million, then obviously that may change your decision making. But here, this is how the penalties work. There is tax and generally a 10% penalty if you're under 59.5 on the IRA owner, tax if you're over 59.5 on a Roth, maybe nothing. And then this is it. There's a 15% excise tax, and it can go up to 100% if you don't correct it timely on the disqualified person. So if I'm the disqualified person, it's me. If it's me and my dad, technically, maybe the IRS could impose it on multiple disqualified people. They kind of have discretion on that. So it's an excise tax. Generally, I've seen the 15%, but they could go up to 100% if they feel like you haven't timely corrected this and you should have been on notice. Remember, they only have 3 years to catch you. Okay, they only have 3 years to catch you. That's the statute. It's 3 years when you make the investment. And if they feel there's a prohibited transaction, the transaction is deemed prohibited on that January 1 of that year. So if you put in 5K and it goes up to 50 million, technically under the prohibited transaction rules, it's 5K at stake, not 50 million. How do I know? I actually have this is the last story I'll say before I get to some questions. This is back in like 2010. So I just kind of started the business. I probably had like a few hundred clients, right? And I had this doctor from New York, Long Island, in his 70s, and he had a bunch of IRAs with us. I think he moved it from another custodian, and he had an IRA LLC, and the guy screwed up. And again, he came to us from another company because we just started in business, and he wrote a check I remember it clearly, it was like $500 from his IRA LLC to a company he owned. And why did he screw up? Is because the names were very similar between the company he owned and another company his IRA owned. Right, so with the checkbook control, he's the manager of the LLC, the IRA owns the LLC, and instead of writing a check to another investment not related to his personal ownership in an entity, he screwed up and wrote a check to his own entity. How did they catch him? He was over RMD age. At that point, he was 70.5. And I think it was in conjunction with like New York State. They were spot checking valuations of IRAs. Randomly, this guy had bad luck, I guess. And it's interesting. The IRS is actually more focused on valuation than prohibited transaction. Why? Because they're not very excited to essentially blow up IRAs, right? Because if you do a prohibited transaction, your IRA is deemed blown up on January 1 of that year, pay tax, maybe a penalty, an excise tax, and then it's no longer an IRA. In the pre-tax world, it's not a good social policy, public policy concept, and they know down the road they're going to get the money. So it's not really very attractive to them to blow up IRAs because they're going to get the money and more of it down the road as the IRA grows. But valuations are very important because they want to make sure, especially with alternative assets, that people are properly valuing their IRA. Because if you say your IRA is worth $80K, but it's really worth $300K, then the amount of your required minimum distribution, the amount of tax you pay would be off the $80K, not the $300K. And that's obviously a big tax difference. So they care. So going back to this example, well, it's not an example, it's a true life story. This shows you how dumb the government is. This guy, they catch him, he screws up. And he bought these properties like back in 2008, right? Before I was in business. And the properties he paid for, everyone remembers what happened in 2008. It's a financial crisis, real estate dropped like 40%. He bought these properties for like literally 30 cents on the dollar. And now this is like 2010, they're up in value considerably. The IRS goes to him and says, sorry, sir, you screwed up. And I remember I was on the phone with him and his accountant and his accountant. And we're like, okay, listen, he has hundreds of thousands of dollars. I think when he had like $700,000 of real estate at that point. I think his basis when he paid for it was like under $300K. He did really well. We're like, listen, it's $500 mistake. We'll pay 100% excise tax on the $500. Like, why are you screwing it up? The guy's a doctor. He's for his family. Give him a break. And the IRS was like, no, he did a prohibited transaction. We are putting our foot down. Sorry, he screwed up. And then his accountant's like, okay, let us huddle up. We'll get back to you. And then the accountant calls me up. He says, Adam, shut up. Don't say anything. We're going to pay the tax happily. I said, well, why? What the hell are you talking about? Why? He goes, listen, we'll pay the tax, no 10% penalty. He's over 59.5. There's no excise tax. They weren't going to penalize him on that. We'll pay, they were going to extra 15% on the $500, whatever, $50 penalty. We'll pay the ordinary income on $300K because now we'll have capital gains for all the remaining money. It's out of his IRA. He's over his RMD age anyway, so he doesn't have to take an RMD. He can afford the tax on the $300K, and now it's capital gains all the way forward. Instead of, if the IRS said nothing, they would get RMDs on the $700 ordinary income, and it would keep escalating as the assets went up in value. And as if he still had those assets today, they're probably worth $2-3 million. Okay, so in 2010 they were $700K. It probably 3x'd, not 4x'd. So what happened is they got ordinary income of $300K, and now on the rest they're getting capital gains of, let's say, 15% versus getting ordinary income on all the appreciation. So it's just governments being small-minded. They wanted to make an example of this guy. And his accountant's like, okay, we'll pay the tax. You guys are morons. We're going to take personal ownership of this. You guys are stupid. Thank you very much. So it just shows you, like, first of all, prohibited transaction. They only caught this guy because they're spot checking valuations. Governments don't think rationally. Think about valuation, but small mistakes could hurt you. And I've been doing this 14 years. That was the only time I ever dealt with a prohibited transaction in 14 years. And we have 25,000 clients. I've never had an audit of a client. Why? Well, the IRS doesn't provide audit data for IRAs. They don't have an audit team for IRAs. Who audits IRAs? It's part of the small business self-employed division, the folks that will audit your 1040 or Schedule C. Generally, in an industry standard, the folks that get audited are the folks over age 73. Now the required minimum distribution age, because again, the IRS is focused on value. So I'm not saying, hey, do a prohibited transaction. No, I'm very proud that I've never had a client. I don't count that individual as a client because he didn't set up the structure with me. He just used our consulting services and he moved the checkbook control to us. But I didn't structure it. I didn't set it up for him. I'm very proud that we never had a client. And Investopedia, they've recognized us as, I think, the leading audit guarantee firm in the self-directed IRA world. We will work with you. I've never had to defend someone in tax court. I hope I never have to, but I've had some letter writing campaigns from clients that we got resolved. So I think it's what sets us apart. We're not just a tech company. We're an IRA company, right? It's the first 3 letters of our name. We're IRA Financial because we are experts in IRAs, and we will make sure that not only we customize your structure, we'll admin it, we'll record keep it, and we'll consult on it so you stay out of trouble. Let me go through some of these questions. I really appreciate their participation. You guys are awesome. Is an unpaid trustee disqualified? Yeah, if they're a fiduciary, they'll likely be disqualified. Thank you for our videos. Found you recently. Well, thank you for the kind words. A portion of my Roth was from a divorce. Okay. Warned me part of her 2 years ago. Can I take out that contribution? It's probably, you're going to have to wait 5 years. Since it's not a direct contribution, it's more of, I would say, a conversion / new time period. So without researching this more, I would say a new 5-year period because it's a new Roth. If you already had a Roth previous, you may be good, but something I have to look at. So Silver Boy Blues, it's the kind of stuff that we will provide free research to our clients. Sometimes I don't know all the answers. Yeah. See, my wife is right. And this is something we will research for you. If I invest in a company from my IRA where I own 49% and my brother owns 51%, can I also do work in that company, write software? And if so, can I take a salary? So Pete, great question. You know, this goes back to my example, right? The entity is technically not disqualified, right? Okay, you own less than 50%. But could the IRS argue under E that you are, as a disqualified person and as a fiduciary of your IRA, that you're dealing with the income or assets for your personal benefit? Now, this is why, Pete, it's all about facts and circumstances, right? Is this actually a personal benefit? Do you need the money from the IRA to keep the business running? Do you have other investors, right? Is the money from your salary coming from your IRA directly or indirectly? Does the company flush with cash and it's not an issue? So these are the kind of things. It's hard for me, and I hate giving you the CYA lawyer speak, but in this case, Pete, it's just the truth. It's hard for me to give you a concrete answer without knowing all the facts. The good news is you're under 50%, so that's great. Could the IRS kind of use the Rollins model to come after you? Maybe, if they can show that you've done this investment to personally benefit you. To be continued. I look forward to chatting with you about that, but it's a great question. Silver Boy, considering the self-record because my financial advisor hasn't grown any funds very much. I get it. Yeah, we have flat fees. Just so you know, Silver Boy, whether you have 100K or 100 million, we're going to give you the same amazing service and hope your asset keeps appreciating. We're going to charge you the same flat fee. So we'd love to work with you. Just let us know. Age 58 and a half now, 1 year away. Okay. Yeah, there's still a lot of stuff you can do with a self-directed IRA. You can do alternative asset investments, have more control, whether you want to do checkbook, full service, where the IRA invests directly. You have a Roth. You want to be 59 and a half in 5 years, and then you'll be able to get tax-free Roth growth as a distribution. Can I explain disqualified step transaction? Yeah, I can, and I will briefly now, but it's actually a really good topic for another video. But the way that works is under the step transaction doctrine, if the IRS feels that 2 steps are all part of 1 step, they'll collapse it. So here is a simple example. I give my sister 100K, and a day later, she sends the 100K to my personal business. My IRA lends 100K to my sister. That's okay, right? Because my sister's not disqualified. But the next day, my sister sends my company that I own personally more than 50%, the 100K. The IRS, if they were smart, would collapse those transactions and say, well, Adam, you just basically lent yourself money. Let's be honest, your sister is a straw person. Now, would they be able to catch that? They'd have to put all those steps together. They'd have to say, oh, okay, you lent money to your sister. Now they'd have to go to my sister and say, what did you do with that money? Very hard to find step transaction type cases because it's hard for the IRS to uncover them. But if they do, you could be in some trouble. Thanks for the kind words, Rolando. I love doing this stuff. Love helping folks out. Is what I do, is my passion. Even if I had $1 billion in my pocket, I would still be doing these videos. I appreciate you guys enjoying them. I'm so happy I finally found you. Well, thanks for the kind words, Lawrence. I've been binge watching your videos. It's mind blowing. Well, I hope I haven't put you to sleep. It is mind blowing, literally mind blowing. There's 65 million IRAs. There's $13 trillion of retirement money. And there are millions of Americans that should be saving and investing through self-directed IRAs that just don't know about it. Why? Don't teach it in school. I went to law school. I have a master's in tax law. I worked at some of the largest law firms in the world for 8 years. I never heard of a self-directed IRA. Got lucky. I had a hedge fund client that wanted to use his IRA to invest in a hedge fund. And I, thank God, was asked to do the research on that project. And that's how I uncovered the self-directed IRA world. It's mind-blowing. There are so many cool things you can do, whether it's private stock, real estate, investment funds, cryptos, hard money loans. Not only can you shelter income, can you generate tax-free savings, but you can invest in assets you know and trust, all in a tax-preferred or tax-free manner. So yeah, Lawrence, I'm blown away too. Call today. We'd love for you to be part of our community. It's 25,000 plus, growing strong. It's a self-directed retirement nation. Would love to work with you. Should I change my self-directed IRA to a Roth? I did a video on that. I've done a bunch of videos on Roth. Check out last week's or 2 weeks ago's, last week, YouTube Live last week on Roth conversions. There's no right or wrong, Miss Amazing. The answer is, can you pay the tax? What do you think your tax rate will be in the future? Do you trust yourself as an investor? Do you trust yourself as a saver? And what your tax rate is now? Do you have any ability to shelter any of the gains from losses to minimize the tax? So I could spend hours determining whether someone should do a conversion or not. Again, there's no right or wrong answer, but if you're our client or if you want to be our client, we'd love to work with you on that. Silverboy again, a lot of great questions, Silverboy. It's a transfer from her Roth to mine. So some see it's inherited. It's not inherited. It would go into your name. Inherited if it's from a non-spouse. It would just literally go into your name if it's part of a quadra. But I think you'd have to do a new 5-year rule. Bob, I have access to a lot of private investment opportunities, litigation financing, private placements, etc. Before my self-directed IRA, can invest in those properties. Yeah, I mean, Bob, if you're not the managing partner of those, you don't own 50% or more of those deals, as long as you're not taking fees or commission from those deals, and ultimately the IRA will exclusively benefit from those deals, and sure, they can do them. Do I need to do any sort of fair market value? Yeah, I'd want your IRA to pay the same value that any other investor would, right? If you offer that investment to me and your IRA, we should pay the same amount. Awesome stuff. Thanks, Tony. As I mentioned, I appreciate all your support. If you guys have ideas for video, future video topic, podcast topics, please let me know. Would love to hear from you. The goal is just to provide content you guys care about, right? If I do a video on Zimbabwe bonds and no one cares about them, then what's the point? I want to do videos on topics that people care about, whether you're a client of mine or not, or of IRA Financial. It's more important that people learn from it, benefit from it, get educated by it, and become better, more savvy, and hopefully more successful real self-directed investors. So follow up for Bob, real estate valuation, Zillow, I don't think you need a formal real estate. You don't need to pay an accounting firm or a real estate company tens of thousands of dollars. I think with Zillow, Redfin, even tax records are good. Obviously, if you're investing in a private business, more difficult to get a private valuation. I think you want to make sure that on your capital raise, everyone's paying the same amount, including your IRA. Would it be a violation for me to personally lend to a friend's solo K if they also personally lend to mine? Oh, good question. House help. This goes into step transaction, economic substance. If I lend you 100K and then you lend me back 100K, will the IRS collapse those transactions under the step transaction doctrine? Possibly. So what I suggest, do different amounts, different times. Maybe you lend your friend 50, he lends you or she lends you 40, interest rate's 8%, your interest rate's 9%, 5-year loan, 3-year loan, 4-year loan. Just make the loans different. The longer you can wait between loans, she lends you or he lends you today, you lend them in 6 months or next year. All those are great facts to show that there's no step transaction, and each loan should be respected as in separate economic driven financial instrument, and each loan should have economic substance. So thank you, everyone. It's been a long video, almost an hour, 55 minutes, but it's a lot of fun. A really important topic, but people get spooked by the prohibited transaction rules. They're not scary. They're not difficult. Yes, it helps to have experts help you navigate the rules. But obviously you're free to study the prohibited transaction rules on your own, but just like, I wouldn't suggest pulling your own teeth. You go to a dentist. If you are setting up a self-directed IRA, obviously I'm not objective. I think we're the best around. I think we're the fastest growing and most successful for a reason. I would trust a tax lawyer. I would trust professionals. I wouldn't trust someone that doesn't have those credentials to set this up. This is based off the tax code. This is not based off something that comes from Mars, right? So you want to have tax professionals that work and understand this stuff and have the expertise. And that's how I spend my day, whether it's doing content, live videos, or podcast blogs. But I also spend a lot of time teaching my team this stuff so that they're just as smart as me. Because obviously I can't serve 25,000 clients, but we have a team of almost 90 members that are super smart. Some have accounting degrees, some don't. Some have financial degrees, some don't. But they all are my students, and I teach them everything I know. So when you are talking to someone on my team, it's like you're talking to me, which is probably nicer and better looking. Can I buy a self-storage facility and just sign paperwork in the running of it? Yeah, Tony, you can sign. You can do a storage facility with your IRA, but I don't want to bring in this ugly 4-letter word. But UBIT, unrelated business income tax. But guess what? What a segue. Next week, I will do a masterclass on UBIT, unrelated business income tax, on same time, same day next week, Thursday, 1 p.m. Eastern. And I'm going to explain why buying a storage facility can be done with an IRA, but could potentially trigger UBIT. So thank you, Tony. Definitely everyone should check that out next week. What events might convert someone into a disqualified person? It's not that easy to be converted to a disqualified person. You got to be a lineal descendant of the person. So you are, you're not, or you got to own 50% or more of an entity, or be a 10% or more of an entity, own 50% or more, or as I mentioned, officer, director, fiduciary, highly comp of an entity, 50% or more owned by a disqualified person. So house help, we'll work with you on that. Seems like some great questions. So definitely, if you're a client, ask us. If you're not, what are you waiting for? Join us, or even if you're not a client, we'll give you the answer because we're nice. The most important part is helping everyone so that no one gets into a bind and does something they shouldn't. That's it. I definitely would encourage everyone to check out you're on our YouTube channel, learn as much as you can. Check out our podcast. I do 3 podcasts a week. Check out our website. I generally write 1 or 2 new blogs a week. That should keep you busy enough for the next week. Thank you, everyone. Can I do a loan to a friend at work? Sure. Your friend is not lineal. You can do whatever you want with that person. You could do a deal. You can lend them money. Friend, neighbor, cousin, aunt, uncle, brother, sister. As long as they're not disqualified, you can do whatever you want. Free to do whatever you want. It's amazing. It's America. It's freedom. That's why I love the self-directed IRA. There's nothing more American than taking control of your retirement future. So thank you. Love all the questions. You guys are unbelievable. Love it. And I hope to see everyone again next Thursday, 1 p.m. UBIT. We're going to do a masterclass on everything you need to know on UBIT. Thanks again. Have a great day. See everyone again soon.